Everybody, and thanks for joining us for the stable return update for the month of January 2022. We're going directly into the update of the strategy, and just a quick overview on the performance of some of our peers, like Bergen Berman, Anchorated Strategy, MFS, Prudent Wealth, Capital, and Nordea Stable Return. We saw the month of January, all the funds were essentially negative. Markets have been negative, with MSCI World down 5% and global bonds down around 2%. The Nordea Stable Return the minus 1.4%, and let's say Quadriga Stable Return, in this case the result of minus 0.7, 70 basis point down. So compared to the peer group, although the month has been quite volatile, where no place to hide, let's say, between bonds and equity, both down, credit, investment grade down, we let's say at a decent return, trying to preserve capital. And here we see the strategy since the change of the investment process in the end of September 21. We were still up. We are up 50 basis points since end of September. And considering this month, also considering this month where we're down 70 basis points, and we see, for example, other strategies like European investment grade and European high yield, they are down more than 1%. So what happened this month? Essentially, we had both risk on and uncorrelated strategies losing money. We had exposure to a defensive strategy that we took out, was a pair trade between defensive stocks in the food and beverage sector, market neutral, say, with a short position in the market, European market. This type of trade is something that usually is defensive, but we let's say sold the position at the beginning of the month because we saw that the position was very correlated also to yields, to rising yields. So the yields were rising in the rising environment for the yields. This type of trade, defensive trade, usually suffers. So we sold it. So essentially, we entered the month of January without any risk-off position, neither put option or other, let's say, defensive type of trades or terrorist trades, and we faced losses on our equity exposure. We lost around 20 basis points, and then we lost other 20. Around another 40 basis point, more or less 40 basis point on an uncorrelated strategy, which is commodity-linked strategy. We are long mining companies and commodity producer, especially in iron ore, copper space, and this strategy is, of course, it's a beta neutral with the market, and of course, it's a more cyclical strategy. So when the market was down, it kind of outperformed the market. And but if you look at the correlation with other asset classes of the fund, since we changed the investment process, we see that we don't have any correlation whatsoever with European investment grade. So as usual, as I always say, this strategy, we define the strategy as a fixed income replacement, investment grade type of replacement for European-based investors. We try to keep same volatility and try to have a better upside return compared to investment grade, also keeping correlation to zero. Correlation to high yield is a bit higher, around 33%, and correlation to equity has been 24%, which is in line what we want to get. Low correlation and a beta around between 0 and 0.25 at maximum. If you look at the composition of the portfolio, the month has been, although the market was down 5% in Europe, globally, let me say world, Europe was down a bit less, around 3%. We're running still plenty of cash, very low gross exposure. We have 16% in optionality invested in European stock market, and where we have call spreads on banks and call out of the money call on European markets, and we have relative value trades in equities, some small exposure to dollar, and as a defensive can be defensive, dollar against euro, and in terms of relative value equities, we have exposure in commodity producer, as I mentioned, and the strategies, the trade is beta neutral. It represents 11, almost 12% of the strategy of the fund. So in total, we have more or less 30% invested as a gross exposure notional. So we still plenty of cash, still plenty of leverage. Essentially, we didn't use the month of January, which has been, let's say, also a positive thing, because we are seeing what's going on with the market. The market has been kind of volatile, usual scare coming from potential hiking rates in like more hawkish Fed, more than expected hawkish Fed. They're already discounting 5 hikes this year. And just yesterday, also Bank of England has been raised for a second time the short-term rates, and the speech has been also not much a speech by the governor of the Bank of England. It's been more the votes. There were 4 people within the council of the Bank of England government, the Bank of England. The 4 people they voted for 50 basis point hike, and so these kind of scare a bit the market in terms of potential more hawkishness also from Bank of England. But the real big surprise yesterday has been the kind of pivot from Lagarde. Of course, ECB left everything the same, but she started also to assess potential end of the APP, so let's say the buying program of the ECB, and also there's been kind of a talk of potential hikes twice this year. So the market is already pricing now. If you look at the Euribor, it's already pricing 40 basis point hike. So the rates from minus 45, 50 can go towards 0 by the end of this year. So they really, let's say, not scare the market, but there's been kind of volatility within the bond market in Europe. And for the first time after a few years, the 5 years boomed. Is positive, is positive territory, and the 10-year is now more than 10 basis point positive. What happened on the other side is a risk of the spreads from Bund and Italian BTP and other peripheral European countries as widened around 10-15 basis point. So this kind of deliver a bit of risk of sentiment in the equity market. But let's see the implication, and let's see if we're not so sure that Lagarde is going to actually, of course, you're going to end her program, the ECB program or buying program, but we're not so sure that it's going to be hiking in rates is going to happen. So just for a few short-term market technicals, value versus growth, US spreads, credit spreads, and curve inversion. This month has been, January has been pretty big month for rotation into value and out from growth sectors and stocks. This movement has been pretty big, around 8%, at least in our indicator, and is one of the top percentile move in the history of this indicator. And now we need to see if this type of trend is gonna continue, and the value against growth indicator can keep climbing and reaching new level. We are more exposed as general, as we are more fundamental rather than speculative. We like to invest in things where we can assess a better margin of safety. So we always be with a kind of bias towards type of value fundamental companies, and we can do it through in the equity space, we can do in the credit space. So we are never going to be invested in very volatile high beta technology or hypergrowth type of stocks. So this type of environment structurally is good for us. So if this type of indicator keeps climbing, for us at least delivers not maybe positive returns straight away, but just a better environment for us to trade around and a good, let's say, source of alpha for us. In terms of another, let's say, indicator, kind of concerning, if you look at the past 5 years, 5-6 years, this is the breadth of Standard & Poor. So and we hit Standard & Poor at a certain level, which I also, there are a few other circles there, one in 2018 and the other one in 2020. Let's say don't use the 2020 case. COVID was a really externality and sudden shock. But 2018, we now reach the same level of September 18 before the stock market dropped between 15 and 20% the last quarter of 18. And now when this type of indicator goes down, like it went down from a maximum level in 21 to now where it hit 55% level, can be kind of a concern for us. At least what this indicator is telling me is that they are more or less half of the stocks in Standard & Poor that they are below their 50-day moving average levels. So essentially, there are many investors where for the past year they've been losing money, because half of the Standard & Poor stocks are down, and so what can mean this is a potential, let's say, market is more fragile, and that's why we saw also for the month of January a lot of optionality in put, especially put volume, very big, one of the largest put volume for the past 10 years. And this is also linked to the very poor sentiment of retail investor, because mainly this what we've been seeing essentially been ARC type of stocks going down 50%, 40-50% from their peaks in mid 2021. So this type of environment where essentially the breadth is bad, you have many stocks, especially in the retail space, down 40%. The sentiment in the space is poor. So what we can essentially see, there's going to be less power from retail investor to buy the dip. So there'll be a more type of consolidation. So what essentially happened yesterday, there was some other scare from Facebook, which was down 26%, and Nasdaq ended the day down 3.8%. So the market is still fragile, although it recovered 6% in 2 days at the end of the month, at the end of January. It's still pretty fragile, and so the volatility can be here for quite long, because also this indicator, what says essentially is many people lost money and they are very sensitive to further volatility. They can also keep dumping the stocks they have in their portfolio. Is a kind of red flag for us. And another interesting thing is the curve inversion. So the 2 years higher than 10 years. So that's the direction we are going into now. It's still not inverted the curve, still positive around 50 basis points, as we see in the chart. But this indicator, a couple of false signals the past 50 years, 60 years. And besides this, the other, let's say, signals were kind of good signal of a recession. But what also happens essentially is also it's not just a predictor, but it also can be a cause for recession or slowing growth, because a curve that is essentially inverted, where you have the 2 years higher than the 10 years. For example, the banks are less start to decrease, let's say, the credit growth. So there is less credit in the economy, and with less credit, there is less, say, positive environment for the economy to grow. So this inverted curve is a predictor, but also can be a cause for market slowdown, for economy slowdown, and that's what really is the risk this year. Something that the market is still not talking about, and it's the potential slowdown in the economy in the second half of this year. And essentially, this slowdown comes from inversion of the curve, higher rates, and essentially less fiscal stimulus compared to 2021. So households decrease their consumer spending, which has been, say, very powerful part of the U.S. economic growth. So all these things together can push the economy into, let's say, a slowing phase, and this slowing phase can be dangerous for markets in the second half, because you can see again buying back again the defensive assets like treasury bonds, especially the 30 years and 10 years, the long duration, and at the same time also other safe haven assets, and at a certain point also the stocks, they're going to suffer too. So, and then this is regarding the curve inversion. And the second thing is the credit spreads. Both the CDX yield 5 years and the iTraxx crossover 5 years, they are in highest level since 2020. So they touch level around 340 more or less, and 310 for US and Europe, respectively, in the spread. And this level, they're still, let's say, quiet level. They're still behaving quite well, the credit spreads, but we need to keep looking at always be careful of what's going on in the credit market, because this can be, let's say, a good signal of some more volatility ahead. And with this, let's see, for example, this is the curve in US. So we are seeing hiking expectation that is already embedded in a treasury yield 2 and 5 years, and which is already around almost 1.5 for 5 years. Then we have increasing spread from investment grade, so this pushing the investment grade 5 years already at 2.5%, which already can be, let's say, a decent yield, especially if inflation is gonna get lower again and going back to the 2.5% level. And if we take into consideration double B, so high yield bonds, the 5 years is already pricing close to 4.5% total yield. So it's already kind of, not saying attractive, but is this type of push coming from the yields, higher yields and higher spreads, can be kind of can diminish also the risk premium of the equity market, risk premium of the equity market, especially where buybacks, yes, they're coming back, but dividend yields from S&P, they stay low because of high level S&P. They're around 2%. So at the end, if this trend continues, we're going to have we can get to 5 or 6% in the high yield yield to worst for between 4 and 5 years type of duration maturities. So it starts to be kind of compelling, the credit sometimes compared to the equity, and so this can be also dangerous in terms of a reallocation out from equity into create more credit, and especially high yield credit. So this is for the macro update. So it's been, let's say, considering everything, bonds down 2%, market down globally 5%. The fund was down 70 basis points, volatility pretty low, and we compared to the peer group, we've done better, and for this month. So essentially, what we're doing now is still wait and see, and day by day we add a small position, the one that we really are convincing. And so let's say we're being kind of lucky to not to be heavily invested or fully invested in January. So we didn't take any major position. So we now can take advantage of entering into a few opportunities. We are seeing that the market is, of course, it's always been pretty volatile, but it's giving us good opportunities across asset classes in credit and equity. So in terms of the fund, it was still 44 million euro AUM, and we still have the free share classes, especially for retail institutional investors who are interested. We had a 75 basis point management fee, flat and without performance fees, and no minimum entry. So I think it's for a diversification out from the classical investment grade type of instruments in Europe, which are suffering from long duration type of profile, and spreads they're starting from pretty low levels, so they're very volatile too. Investment grade again this year is not going to be one of the winner in terms of the asset allocation, and I think we can do better in terms of keeping the same volatility, keeping the same volatility profile, the same beta to the equity market, but a better upside returns. And with this, I thank you all, and wait to update you next month. Thank you. Bye.